Hi, I'm James Robinson, and this is my stock pick of the week. This is my third part of my 5-part series on the company Intel. Today we're going to look at the company's balance sheet. I think the balance sheet is underrated in terms of its importance. What we can do here is see how much cash the company has in the bank over time, how that's been affected. Cash is a measure of safety, right? How well the company is doing in terms of having reserves for the future, money to invest in other opportunities that may occur. The flip side of that is we get to look at the company's debt, which is important because debt's one of the few things that can put a company out of business. We also get to look at interest payments and how those are going to affect our profitability going forward. So I don't think people spend enough time looking at the balance sheet because it doesn't matter what you do right. If the balance sheet's out of line and the market turns against you or the economy turns against you, it can be the end of your company. There's lots of places to start when looking at a company's balance sheet, but I tend to start at cash and marketable securities because that really is your buffer zone against things going wrong in the future. You can tell a lot about a company by what's going on with their cash and marketable securities. For example, you want to have a company have a reasonable amount of money in the bank. And as the company grows and its operations grow and its cash needs grow, you'd like to see that number increase over time. By the same token, what you don't want to see is it just getting unbelievably large and them hoarding cash. At the end of the job, the company's obligation is not to have as much cash as possible in the bank. It's to return as much money as possible to the shareholders, because that's why we're running this thing, is to make the shareholders money. So it's a kind of a balancing act. And so when you look at Intel, the first thing you're going to see is that the company has $13 billion in cash. That's a tremendous amount of cash. It's certainly more than the company needs for its operations. And so on the one hand, you're great. That passes my safety test. There's plenty of money there for the future. But then you say, okay, they're hoarding cash. And the good news is they've gone from about $25 billion in cash in 2017 to about $13 billion today. That means over the last 4 years that either they've run the operations poorly and that they've needed that money to run the operation, or they've been returning money to the shareholders at a great pace because they've been returning not only 100% of the profits, but some of past year's profits to us, the shareholders. Now, when we looked at the video on operations, you could see that the company has never had a losing year. And so you know that, in fact, the company has been returning excess cash to the shareholders. So that's a double whammy in terms of good sign. First, the company has a good buffer. Second of all, the company is returning money to the shareholders. And that is a third positive sign, which means that the management seems to get it. They seem to understand their obligations not to hoard as much of their cash as possible, but to return to the shareholders. So this is top marks for Intel on cash and marketable securities. So this slide looks at not only cash and marketable securities, it also looks at investments and advances. I don't know if I've talked much about investments and advances before for those of you who aren't accounting guys. So cash and marketable securities is assets that you intend to, it's either in cash or short-term investments. Investments and advances are, the investments really component of that is investments that you intend to hold for longer than a year. So it's a long-term hold investment, sort of like a long-term debt versus a short-term debt. So when you look at these charts, what you can see is that, this company still has around $20 billion of owners' cash tied up. About $8 billion of it is tied up in investments and advances, and another $12 billion is tied up in cash and marketable securities. Again, that's a tremendous sum, but when you look at both of these numbers since 2017, they've come down in a pretty straight line. That shows that the company does understand that their job is not to be an investment portfolio with all these fantastic investments. Their job is to return money to the shareholders, and again, they've been doing that. But it is nice to know that this company has, about $20 billion in reserves if they need it. So current assets are assets that you expect to receive, assets that could be liquidated within a year or that you'll receive within a year. And current liabilities is money that you will owe within the next year. And obviously, as you can imagine, you like to see a nice safe buffer between those two. You like to know that the money that's coming in or that's accessible to you in a year is more than offset by the money that you're going to owe in a year. This company's always been very, very safe. And again, you see that this band is not too wide and not getting wider. That shows management they've created what they feel is a safe, comfortable buffer zone, and they are managing to that and not keeping more money than they need to. one of the reasons it's important to me that they don't keep money that they don't need to is I believe I can do a better job with the money than they can. I believe that they're pretty good at making silicone chips. I don't think they're very good investors. Otherwise, they'd be an investment company. And so I don't want to see them hold too much of my money. I want to get as much of my money back as possible so that I can go do what I want with it. So that's one of the, also money that's returned to the shareholders tends to be an indication that stock is going to go up, right? So if they're paying higher and higher dividends, those higher dividends makes the stock more attractive, which makes more people want to own it, which makes my share value go up. So this is current assets and current liabilities, yet again, a good sign that the management is managing risk and managing our money well. So sometimes you have to take the good with the bad. Here we look at the debt analysis for Intel, and this one's no fun at all. You can see that the company's current liabilities, which is blue, which is really short-term debt, it goes up. That's not a problem to me. The company that is growing will take on more and more current obligations as it grows, right? If you can imagine that they're selling more chips, well, then they need more materials to sell them. They have more employees working, more factories, more research, you get it. But total long-term debt bothers me because one of the ways that this company, I just don't understand why a company is making as much money as they are and has as much reserves as they do, needs to have $22 billion in debt. Now, the good news is that it's been flat for the last 3 years. Hopefully that trend continues. I would like to see that number even come down. But what I'm seeing a lot with companies is they just are looking at interest rates as 3 and 4%, and they think they can do better with the money than 3 or 4%, and so they're loading up on debt. Again, I don't love this strategy, but I'm seeing companies do it. The debt, by the way, is really manifests itself as a negative for the company in terms of interest payments, and the interest payments are in no way an issue relative to the company. We'll look at that later. So while I don't like seeing companies that take on debt, it's always a red flag to me when a company is increasing its debt. In this case, I've just kind of chosen to overlook it. It is what it is. It's not a problem for the company currently, and so we just sort of recognize it's there and sigh and hope the company will do better in the future. These two slides will show you why I'm absolutely not concerned at all about the company's debt, really. I like to have a company that's interest expense should be less than 15% of operating income. That's sort of arbitrary, but there's some reasons why I've come up with that number. And therefore, if a company's above that, I start thinking they have too much debt. If they're below that, I kind of give them a pass. And you can see that they're at 3%. So, they're 1/5 of where I want to see a company be in terms of debt obligations. And therefore, I'm really not worried about this company's debt. Again, it bums me out they're taking on debt, but it really, in the scheme of things, it's just not something to get upset about. And that's even doubly true when you look at the next slide, which is both interest expense and interest income, and therefore the net interest income or loss. And you can see that while the company has taken on debt and their interest payments have gone up over time, their interest income has also gone up significantly, and those two are sort of a wash now. So the company doesn't have any net interest expense at all. And so again, you say, well, okay, so they have some debt. I guess that's okay. You kind of look at them like a naughty schoolboy. You give them a swat on the butt and tell them to stop it and hope that they listen. But I'm not really worried about the company's debt obligations at all. Interest coverage ratio is just to look at how much their income is relative to their debt obligations. And I like to see a company's interest coverage ratio is no less than 3.5 times. So they have 3.5 times the earnings that they need to pay their interest payments. You can see here that Intel is around 45 times, so they're 15 times as much as they need to. This points out that interest isn't a problem. Again, the debt's not a problem for the company. And so there's not really much else to say about this slide. The final quick check that I used on a company is I like to get a sense of what the company's debt is in relation to their income. Is the debt too big relative to the amount of money the company's making? And since every company makes different amounts of money and has different income levels, I like to use this chart as a quick guide to get a sense of it. What I'm really doing here is I'm looking at how many years of income it takes for the company to pay off its debt. So if they took 100% of their profits and did nothing with that money, but used it to pay down the debt, how quickly could they pay down the debt? And I like to see about 4 years. So I like a company to pay off their debt, to be able to pay off their debt in 4 years or less. I start thinking that a company is really sort of uninvestable, if it's taking 10 years or longer to pay off their debt. So with this company, again, it's in the range of a year and a half or 2 years to pay off its debt. And that's actually, it's probably in the range of a year and a half. Yeah, year and a half to pay off its debt. So very, very safe. The debt is dwarfed relative to their income and therefore not really a problem. So let me review the balance sheet for this company. The debt is not really a problem today, but they have been raising their debt over the last 10 years, which I don't really like. It's been flat for the last 3 years, which is better. The company has a lot of cash and marketable securities, about $12 billion, $20 billion when you include long-term assets. But those numbers have been coming down nicely over the last few years. The company's interest payments aren't a problem, and the company's income relative to the debt shows that the company doesn't have too much debt. So the balance sheet for Intel is very, very strong. As an investor, I would look at this company and feel very safe that Intel's going to be able to survive things like a pandemic or whatever else might come up, and give itself an opportunity to maneuver and get through whatever tough times might come up. So that's it for the balance sheet portion on Intel. Thank you very much for watching.